Let's take a tour of the factory, find out what this pulp is about to be. In a big machine up the belt go by, got to get it very wet because it's very dry. Got to mush it, mash it, make it into slurry. Hurry, can't rest when a mess is occurring. Tidy it up.
Welcome back. Today we're going to continue our discussion of economic growth, and we're going to begin looking into the questions of, well, where does economic growth come from? And we'll take a look at we'll do a little warm-up thought exercise here, which I like to call naive growth theory. But first, just a quick review. Let's recap what we learned in the last video from Professor Tabarrok, some basic facts of economic growth. Okay. And I'm going to put it in these terms. Growth is recent. Okay. In the Western world, US and Europe, it's really only been happening in the last 200 to 500 years. It really began about 500 years ago, but it's really only been significant for the past 200 years, the Industrial Revolution. And in other parts of the world, it's even more recent. China has basically had growth occurring for about 30 years, maybe a little bit more than that. Some other parts of Asia, maybe 50 to 100 years. Okay. But growth is pretty recent, especially when you consider that the scope of human civilization really only goes back about 10,000 years. We've only had significant economic growth in the last 200 of those. It's brand new. Okay, growth is brand new. Okay. And the other big aspect of growth that we want to focus on is how rare it is. Okay. 80% of the world is below the average real GDP per capita. Okay. The bottom 2 billion people is about the bottom third or so of the people on the planet live on less than $2 a day. Okay, abject poverty, the kind of wealth that we take for granted, and the kind of productivity and like GDP per capita levels we take for granted in the United States, is very rare, both across the world right now and across history. We are essentially the richest generation of people who have ever lived anywhere in the universe. I'll take you back to this chart from the textbook, which shows the cumulative distribution of world population by GDP per capita. Okay, this is a little outdated because it's using year 2000, base year $2,000. U.S. GDP per capita in current dollars is actually about 50,000, but the trend here is still pretty much the same. Okay, you see that this is a very skewed distribution. So we've got the top 20% here of the world's population living at or above the average. Here's the average, which is about 9,000 back then. It's a little higher right now. It's closer to 10,000. Actually, I think it's closer to 11,000 right now. But here it was 9,000. Okay, and here we've got the U.S. We've got 315 million people now. That's a big bunch of people. Okay, so we've got a lot of people living at a very high level of income, GDP per capita. And Western Europe and parts of South America are a little bit above average. Mexico is just about average. But look at the majority of people, okay, 80% of the world's population living below the average, and most of them well below the average. Okay, look at China and India alone, which together have more than a third of the world's population, and they are essentially half of the average. China's grown quite a bit. I think they're currently in the 6,000 to 8,000 range. India's in the maybe 35,000 to 4,000 range, but still well below the average. Okay, and then you've got the bottom of the distribution here, very poor. Okay, we talk about less than $2 per day. Here we have 8% of the world's population live in a country with annual GDP per capita less than $1,000. Okay, that's what we're talking about here. In the bottom 2 billion here, less than $2 a day of personal income. There's a slight difference between personal income and GDP per capita. Okay. But we've got most of the world down here very poor. Most are very poor still. A few are very rich. And what economics wants to do is try to understand this. Why? What's going on here? Now, a lot of people, and especially the outside of economics, a lot of people just want to say, well, it's so terrible and it's so unfair that all these people are poor. Well, be that as it may, they want to explain what causes the poverty. In economics, we say, no. It's not what causes the poverty that we're interested in. What causes the wealth? Remember, let me go back here. Growth is the thing that's recent and rare. Okay, growth is the thing that's new. Okay, that's different. Growth is what we need to explain. Poverty is the default condition. Okay, wealth or economic growth, which is what causes wealth, is what we need to explain. And that's what we're trying to get at in this unit. What causes wealth? Okay, and I want to start off, we'll take our first crack at it with what I call naive growth theory. And naive growth theory is some simplistic explanation that basically says, well, look, if you've either got resources or you don't. And if you've got resources, and what we're talking about here, land, labor, and capital, we can think of classical factors of production, natural and human resources. If you've got them, you're going to have a successful economy, you're going to have growth, you're going to have high levels of productivity and income and wealth generation. And if you don't have them, you're not going to do so well. Okay? Well, I want to do a very simplistic test of that theory, and we're going to do this kind of with the Adam Smith method of just kind of observing based on some general knowledge. And this is mostly illustrative, but I think this will be very helpful in guiding our thinking on where economic growth comes from. Okay. So what I've done here is I've created a table we're going to list some countries. We're going to take a look at countries by real GDP per capita, so we'll look at rich countries and poor countries, and then we're going to just think about, well, what is their access to resources, both natural resources? So I have noticed land, labor, and capital, the classical factors of production. Land, we want to think of that in terms of natural resources. It's not literally just land. Of course, land for growing crops is important, but also the things in the land, things like minerals, oil, and energy resources, metals, and also the climate. Okay, do you get rain? Good land is useless without rain. Okay, so it's the climate, the whole package of natural resources. Labor, it's not just the number of bodies, okay, but it's how many people you have, what's their health like, what's their education like, what's their training and skill and experience to do various tasks. Okay, so we want to think of that in terms of human resources. And then capital, which is tools and equipment, okay, factories, vehicles, tools that magnify and multiply the power of labor. So we want to just think about countries and think about, well, what is their access to these resources, and can this explain the observations we have about high real GDP per capita, countries that have experienced growth. Let's start off with one that we're pretty familiar with, and we know that's the wealthiest large country, as Professor Tabarrok said. U.S. with our real GDP per capita of about $50,000 at the very top of the charts. And what is our natural resources situation? Well, I hope you've driven around the country. I have. It's pretty fun to just observe what's going on out there in the fields and the farms and in the mines and factories and whatnot in the U.S. And the fact of the matter is, yes, we have very abundant natural resources. You basically name any industrial mineral, all the metals, we have mines that produce them in the U.S. We have oil, we have natural gas, we have very good farmland. We're living right in the middle of some of the best farmland in the world, and we get lots of rain here in eastern Indiana. So we have excellent natural resources. It's a very large country with a diverse set of natural resources. We have coal, we have oil, we have iron, we have copper, we have natural gas. Okay, we've got it all. So very blessed with natural resources. Labor, human resources, well, we're a large country, so we've got lots of people. More importantly, probably we have a highly educated, okay, we have a highly literate, we have a fairly decently functioning educational system, and we have a highly educated, highly experienced, highly trained labor force, generally speaking, relative to the rest of the world. Okay, so we're very endowed with human resources and labor. And of course also capital. Just look at any city in the U.S. Look at the buildings. Look at our infrastructure. Look at our highways, our railroads. Look at our factories. We're probably the most capitalized large economy in the world today. So U.S. has got it all, and we have high real GDP per capita. No surprise. Okay, so naive growth theories. If you have all the resources, you're going to have growth. Seems to apply. Just to kind of give a sense of all the resources coming together in one place. This is a steel mill. I think it's currently the ArcelorMittal up in East Chicago. So this is up on Lake Michigan, northern Indiana. And I'd like this as a representation because, of course, you can see the capital right there. You can see the factories and the railroad tracks and the buildings. That is capital. Okay, that's a capital complex, a very highly productive capital complex. But it highlights some other resources. It highlights the natural resources we have in the U.S. Of course, there's the Great Lakes, one of the greatest sources of fresh water in the world. That's an important resource in and of itself. But the neat thing about Indiana's steel industry is that the natural resources come in on Lake Michigan. You bring the iron ore down from northern Michigan and Minnesota. You bring the coal up. You bring that down on Lake Michigan on the freighters, and then you bring the coal up from West Virginia, Pennsylvania, Kentucky on the railroads, and it all meets here. And of course, it's combined with the human resources. There's thousands of very skilled steel workers who know very technical processes of turning those raw ingredients of ore and coal into the finished product of high quality steel. So there's kind of, if you want to think about, I think this is a useful way to think about it, the combination of all those resources making America a very productive economy, a very successful industrially developed economy. So there you have it. Think about another example, which is Britain, which actually not quite as high as the US, but 100 years ago was the most productive and wealthiest economy in the world. Still pretty successful. Their real GDP per capita currently about 36,000. And do they have the land and natural resources? I'm going to say yes. Okay, others might say no because they're a small island nation. But when you think about industrial development, Britain actually did have abundant energy. Okay, they had a lot of coal and they had iron, which made industrialization possible. Okay, and they have some capacity for agricultural resources and of course, a comparatively large and well-educated, skilled workforce, and of course capital as well. This is, after all, why the Industrial Revolution started here and how they grew. Sort of the iconic example in my mind would be Manchester, which was the seat of the Industrial Revolution in Great Britain, starting in about 1700, starting sometime in the 1700s. And here's a picture of Manchester from probably around 1900. You can see the city's just basically one big factory. You're probably familiar with the soccer club, but this is when I think of Manchester, I think of the industry and the capital, okay, and the resources being turned into useful products for the mass of consumers. And this is what starts to raise the real GDP per capita in places like Britain at the beginning of the Industrial Revolution. So there's the U.S. and Britain fit well with the naive growth theory. You've got the natural and human resources in the capital. You're going to have the growth. Okay. Well, we could probably list a lot of other large industrialized high GDP countries here, and they would fit. But I want to draw your attention to an economy that maybe tells a different story. Let's take a look at Hong Kong, which actually has a real GDP per capita currently higher than the U.S. Okay. Hong Kong, a very small country in off the southern coast of China. And do they have land and natural resources? The answer is a resounding no. Hong Kong is a very small island. Part of it's an island, part of it's just a small spit of land off the southern shore of China. Hardly any land to speak of. No coal, no minerals, no oil, no cropland. So basically, a very tiny country devoid of natural resources. Now, do they have human resources? Do they have a large, skilled, educated labor pool? Yes, it's a highly densely populated place with a very well-educated labor force. And it's also a highly capitalized, highly industrialized economy. Actually, before the ascension of China as a manufacturing power, you would see the label made in Hong Kong. Okay, Hong Kong was an industrial Southeast Asian power well before China. Okay, so, well, here we see an example of a very successful, developed, rich economy with no access to natural resources within its own shores. Maybe naive growth theory is starting to fail as an explanation. And here's a picture of Hong Kong for you. It's one of the most densely populated places in the world, 6,500 people per square mile, and it has some of the highest rankings of economic freedom. It's a free trade-based economy. It's a very capitalized, very developed economy. So capital is abundant there. You can see the skyscrapers, the very colorful night sky there. Capital is abundant. Human resources are abundant. Natural resources, they don't exist within Hong Kong. Okay, now they can bring them in from the rest of the world, but they don't exist within Hong Kong. Let me point out an even more obscure example. Have you heard of this one? It's an actual country. It's right next to Switzerland, up in the Alps, Liechtenstein. Get a load of this real GDP per capita. Per capita is about $100,000 worth of production, which means an average income per person close to $100,000. Wow. What's going on there? They must be sitting on top of an oil well. No? Natural gas? No? Gold mines? No. No, it's a very tiny country. Little natural resources to speak of. There's a few farms and they raise some cattle and goats, but up in the Alps, not really any natural resources to speak of. Okay. Now, they do have a very highly educated and highly skilled workforce. I'm going to put an X here though because it's a tiny country. The whole population of this country is 35,000 people. So they have a few thousand highly skilled workers, but as far as having an abundant pool of labor like the US and Britain have, or have had, even Hong Kong with 7 million people, they've only got 35,000 people. So comparatively very small in the human resources category. But what do they have in Liechtenstein? Capital. Okay. They have tools and equipment that make their small workforce very powerful. Here's a picture I took. I had the privilege of actually taking a trip there a few years back. And it kind of looks like just a quiet Swiss alpine village, several little villages. But if you look on the right there, that is one of the secrets of Liechtenstein's success, which is their financial district. Those are all banks. Those are Liechtenstein's a banking center. It's also a manufacturing center, and it's got some of the they claim to be the most industrialized nation in the world on a per capita basis. They have some of the most technologically advanced manufacturing in the world. Okay? So they are capital rich, capital intensive, and this is the main thing I would submit to you, that when we're looking at naive growth theory in terms of land, labor, capital, one thing that the rich countries all really do have in common is capital. Well, why does natural resources and human resources not matter so much? Liechtenstein, in their manufacturing, they need things like steel and they need oil to run their manufacturing, which is true. But here's the thing: natural resources like minerals and commodities and energy commodities, they're available on world markets, so you don't need access to them within your own borders. What about human resources? It's nice to have an indigenous, highly skilled workforce, but there again, you can always import workers just like you can import commodities. You can bring in highly skilled people with technological training and knowledge from almost anywhere in the world. And Liechtenstein they have free travel. They're not in the European Union, but they can benefit from the free travel within the European Union. So they can bring in skilled people all throughout Europe, from North America, from Asia, and they can man their industries with skilled people. So they don't need to necessarily provide them from within their own borders. Okay. What they do have within their own borders is various kinds of capital, ranging from everything from that high-tech manufacturing equipment to their financial sector, which is largely human capital, but it's also physical capital, computer networks, and that kind of thing. Okay. So what the rich countries have is capital more than anything else. To round this out, let's take a look at some poor countries. And again, we can look at, there's several examples of poor countries. I just went to a list on Wikipedia and picked a poor country, Sudan in Africa, Eastern Africa, real GDP per capita of only 2,500. And this is a desert country. They actually do have some oil. Most of the oil is in the southern part, which seceded and actually isn't doing any better than the north. But the north of Sudan in particular, it's a desert country, not very good for growing crops, not much in the way of natural resources. Human resources, it's a large country, but here I put in an X because it's a very poor country, which means it's not a well-educated country, which means that their workers don't have much skill and knowledge and training. And of course, also lacking capital. There's in the industries they apply very primitive methods and means of production, which means their workers aren't very productive. Okay. And what I want to focus on here is that whereas in some cases it will look like, well, you lack all of the resources and therefore you have no growth. And here's a picture of Sudan. You can see that just very primitive, little capital. It's a desert. Natural resources aren't that abundant. Okay, so you might think, well, yeah, Sudan, they just didn't luck out with the natural and human resources endowment, so it's not surprising that they're not very productive. Well, let's take a look at some other countries. Take a look at Nepal. Even lower than Sudan in terms of the real GDP per capita, 1,300. Now, very little in the way of natural resources here as well. Some beautiful scenery, but some very vicious scenery. This is the Himalayas. Okay, most of it's highly mountainous, no minerals there, and it's very hard to grow crops. They do have a very small stretch of land, which is down in the valley region. They can grow some crops, but it's still very precarious. Okay? They don't have minerals, they don't have oil, they don't have metals. Okay, so they have no natural resources. Now, they do actually have a fairly well-educated, literate, larger population, so I'm going to give them a check mark here. Um, but they don't really have much capital. Okay, no big factory complexes, no large developed cities, infrastructure, and that kind of thing. Here's a look at a mountainside village. You can see what a challenge agriculture is. The way they have to terrace that land to farm it, they just can't get large-scale agriculture going. And the climate is very harsh. I'm going to suggest that it's not the lack of natural or human resources that will make a country poor, but the lack of capital. Um, Finally, India. Now, here's a large economy that has a lot of natural and human resources. India has It's a very large land area. They have regions that are good for growing crops. Okay, they're actually very productive agriculturally. Why are they still so poor? Well, we'll talk about this a little bit. I'm going to do an offshoot on India's agriculture sector. But the fact of the matter is that they're lacking in capital. Okay, they actually have a large labor force, most of which isn't very educated, but it's such a large country, it's over 1 billion. They have hundreds of millions of people who are educated and have knowledge. Okay? So they do have a large pool of highly skilled and educated people, and they have a lot of natural resources. Well, why is their GDP per capita stuck at 3,800, at less than a tenth of the US? Well, I'm going to suggest to you it's because they lack capital on the same scale of the industrialized developed economies like the US, Britain, Western Europe. And here's a view of India. Now you can see there's vehicles there. There's capital. Okay, there's some infrastructure. But look at all the people hauling stuff on their heads. Okay, look at the people hauling stuff on hand-powered carts. Okay, most of the traffic here is people hauling stuff on their backs, on their heads. Only a little bit of it's people using trucks. So what you see here is there's some capital, but not nearly as much. Go to Indianapolis, go to Muncie. Do you ever see people hauling building materials, hauling food in rickshaws or in big baskets on their head? No, we use trucks for everything. They use trucks about half of the time. Okay, so what's going on here is they're lacking capital. Which brings me to my summary, and this is my conclusion that I'll draw from naive growth theory. What causes economic growth? Well, look at the thing that the rich countries all had. Look at the thing that the poor countries all lacked, which was capital. Therefore, what causes growth? Well, quite simple. It's capital, baby. Capital causes growth. And we're done. That's it for Unit 2. See you next time. We'll start in Unit 3. No, I'm just kidding. It's capital, baby. Well, to say that, it's somewhat useful, but it's not going to help us understand why some countries are rich and other countries are poor, because it only raises the question, okay, where does capital come from? Why are some nations rich and others poor? That's really to ask, why do some nations have capital and other nations don't? Where does capital come from? Okay. And this is the question that economics has been asking all along. And it's basically the question that's built into the title of Adam Smith's book, which came out in 1776. You probably know this as The Wealth of Nations, but the full title here, this is the title page of the book, the full title is An Inquiry into the Nature and Causes of the Wealth of Nations. What makes some countries rich, and by implication other countries poor. Adam Smith focused quite a great deal on capital. Okay? If you read chapter 1, you'll notice he talks about the division of labor that's empowered by the development of machinery. Okay, machinery would be capital. So Smith is going to focus quite a bit on capital. A more recent example, and this is by a pair of excellent economists, Acemoglu and Robinson, and this book came out last year, Why Nations Fail, and Acemoglu said, well, we took this title because Adam Smith had already took the title of Wealth of Nations. So their title focused kind of on the negative, where Smith focused on the positive, but they're asking the same question. What makes some countries rich and other countries poor? Now, are they going to talk about capital? A little bit, but I like Acemoglu and Robinson's approach because they're going to try to address this question of where does capital come from? It's capital. Naive growth theory says, well, capital is the thing that all the rich countries have, but why? Why do some countries develop capital and other countries don't? And the answer that Acemoglu and Robinson, and I think many other good economists are going to suggest here, and you're going to read about this in our textbook as well, is institutions. Institutions, we're going to focus on the social, legal, political, and cultural structures that determine the incentive structure faced by that prime economic agent, the entrepreneur, in a particular economy. Okay. So where does capital come from? Well, it comes from entrepreneurs investing and creating capital. what determines entrepreneurs' incentives across countries, so where they're more successful in creating capital in some countries than in others. Well, to answer this question, we ultimately have to get down to the bottom layer here, which is the institutional structure of that economy. Okay? And that's what we're going to look at next. We're going to dig down and talk about what we mean by institutions and what determines the institutional structure and how institutions operate. And our big motto here is going to be that institutions govern incentives. Okay? And when people face different incentives to be productive versus to not be productive, to build capital versus not building capital, that is ultimately what's determining economic growth. That's it for naive growth theory. We've gotten to the point where we realize that institutions is crucial. So in the next lesson, we're going to take a deeper look at institutions, what they mean, where they come from, how they work. Stay tuned. See you then.